Hello and welcome to Livewire Markets Fund in Focus. I'm Anna Dadich. As part of the Alternative series, I'm joined by Paul Miron, co-founder of M Squared Capital. He's going to be speaking about two of their products, the M Squared Mortgage Income Fund and the High Yield Mortgage Income Fund. Welcome, Paul.
Thank you, Anna.
So can you provide a brief introduction to M Squared Capital and what inspired its creation back in 2018?
The co-founders have had careers in banking and finance before. We saw an opportunity in the marketplace where we saw a opportunity for investors who wanted to participate in private credit and borrowers who required alternative forms of finance. And so that's how we started M Squared Capital.
Let's talk through your strategy, starting with the M Squared Mortgage Income Fund. How does it work and who is it designed for?
Sure. So just prior to that, just giving you a little background, when we started the business, we started the ability to do what's called contributory funds. And so the way that we did it is that people could choose the individual transactions they want to invest in. So to really understand the philosophy and the strategy in relation to the income fund, the best way to go through it is with a live example. So for example, a client comes to us, he has a $10 million property in Mossman, and he wants to borrow $6.5 million. In that type of situation, we'll take a first mortgage, and the 0 to 55% as per on the screen, the investors will get approximately 7.5% return, and at 55 to 65%, investors will get 10% return. So from a risk perspective, what does that actually mean? Well, it's still a first mortgage, but if in an event of default and we have to sell that asset, and for argument's sake, we sell it for less than 6.5 mil, the people who are invested in that top part of the triangle, their capital is at risk, but the bottom is not. And the reason why we did that, after many years of running M Squared Capital, the demand came from our investors. They wanted something that was very simple to understand and had certain mandate and parameters. And we have a lot of self-directed investors, self-managed super funds, religious organizations who invest into that income fund, which meets their requirement. The philosophy is this, is that on average, our gearing is about 55% in that fund. There are short-term loans, anywhere between sort of 6 and 12 months. So actually our average loan term at the moment is around 7.5 months. So we have to turn that money over. The mandate there is really easy to understand, is that all the security that we have in that particular fund are completed property. Means that in any type of cycle, within 6 weeks, we can put that property on the market. And it excludes specifically second mortgages, construction loans, specialized security, rural. Those type of securities or those type of loans have more tendency to have a possibility of a loss than any other. And so we created that product. It's easier to understand. There's a lot of transparency there as well. We created it as a retail product so that as many investors can have access to it, and investors can have up to monthly withdrawals as well. So it's purposely designed to find what we believe is the best risk-rated return in the marketplace for private credit.
Okay. So turning now to your high yield mortgage income fund, how does this strategy differ and what kind of investors is it suited to?
So through our experience with talking to all of our investors, there is a large cohort of investors, majority, who love the income fund for that low risk parameter. However, there's lower return. And there's another cohort of investors who want to have a higher return and they're comfortable with that risk as well. So they're comfortable to have a little bit of exposure to construction. They're happy with that risk because they're getting 10% return. We designed that product specifically for those investors. Now, the enhancement is that second part of the triangle is a very specialized and hard to get access to that type of opportunity. And we've created a fund that has the majority of the investment in that second part of the triangle. Which, if you ask many investors, is that do they believe that properties in blue chip areas are going to fall more than 45% or 30% or 20%? And they say it's unlikely. And so therefore, they're very happy with that return.
What's the opportunity you've identified in today's market and why is it now an interesting time for private credit?
Well, the private credit in Australia, if you look at from a global perspective, it's considered to be the highest quality private credit in the world. If you compare it to the US, and there's a lot of conversation in relation to investing into US private credit. But if you look at the two, from a risk perspective and a reward perspective, they're completely different. The margins are compressed in the US so much that investors are only getting a 1% above cash rate. Here it's about 3 to 5. So Then from a legal framework as well, and even though Australian private credit is very small in comparison to the rest of the world, and even private credit in Australia compared to the other lending landscape is also a quite small slither, it's tiny. However, if you look at it and compare it from a risk-reward perspective, it's completely different. So the laws in Australia are very different to other parts of the world. If you default on a mortgage and you have a personal guarantee, you're going to lose all of your other assets as well. It's a very big stick in relation to the right type of behaviour from borrowers in not taking too much risk. And so therefore Australia is quite unique from that perspective. So from a investor perspective, if you know where to look, you can gain a great opportunity of an asset class that has asset preservation qualities and gives you very healthy returns as well.
So why do you see this as a compelling opportunity, and how are you positioning the funds to capture it?
Anecdotally, it's quite interesting. 8 years ago when I started the business, many people didn't even know what private credit is. It's the hottest part of real estate and funds management at the moment. It's estimated to double in the next 5 years as well. At the same time, there's a lot of competition as well. Now, we don't want to be taking a situation where we take more risk on behalf of our investors to keep deploying capital. But I believe that the best thing that we can do as a fund manager is to keep finding niches in the marketplace where the best risk-rated returns are. So we're never there to try to find the highest return in private credit. What we want to find is where we find stability, and we're quite conservative as a fund. So we look forward to the growth that we'll have over the next couple of years as well.
Yeah, sure. So what's different about the way you invest compared to others in the private credit space?
I think our philosophy is very different. The way that we look at deals is very different, and transparency. Very often investors call our team up to talk about individual deals. We even give an opportunity for our investors to see the full build book of all of the loans in our funds. We have nothing to hold back on that as well. So once people see that, they see and understand the quality of deals and opportunities that we have, that we put into the fund, and then it allows them to have a better understanding in relation to the risk perspective of it as well. I think that's another issue that we have in the current marketplace, that because we're a very infant sort of industry, that transparency piece we have to find better ways actually being more transparent with investors and educating them in relation to risk and reward as well.
Private credit has become very popular.
Yep.
What are the key risks investors should understand, and how does M Squared manage them?
One of the most interesting parts of the way that people look from risk for private credit, they look at what your return is and what your gearing of your average book. Okay, and that's the two ways that you look at it. And it's pretty hard to compare one fund manager to another. However, our philosophy is, and I think I mentioned to you before, there is a huge difference between a mortgage against a first mortgage and a second mortgage. There's a huge difference between risk in relation to when you're lending against a construction loan. There's so many things that can go wrong, which is outside the control of the lender, the borrower, the developer. We've seen it before. It only takes a few more rain days and there's delays. That industry can be put under pressure. Specialized security. Specialized security is another one that we don't touch at all, is that a lot of value is placed on a property based on its cash flow. So if there's something happens to that cash flow overnight, the value of the asset disappears. So the likely chance of losing money on a specialized security is a lot higher. Now, don't need to mention that we're probably going to have one of the largest corporate collapses happening right now, $1.8 billion worth of debt, and pretty much all of that was on specialized security. And we don't touch that because we understand the nature of that risk. So we don't put it into our funds. Rural property, there's nothing wrong with rural property, but at the end of the day, it can be quite illiquid, and liquidity is really important for our investors. So when you start looking at the type of loans, really, really important to understand the risk associated with it. And when you put it into the right portfolio, that enhances the risk analysis for investors to understand where they sit from a risk and reward perspective.
For investors building a portfolio, what role do these funds play?
Yeah.
And are they a core income alternative or a diversifier alongside equities and bonds?
If you look at macroeconomically and looking at the evolution of how portfolios have been constructed, there has been an evolution over the last 80 years. The traditional 60-40 split doesn't necessarily work as well going forward. And given the fact that most of the wealth that we have right now are people in the baby boomers as well, and their time horizon has changed. So there's a much more appetite for income. There's much more appetite for sort of asset preservation type of asset classes and alternatives. And so therefore private credit and even private markets are now filling that gap as well. So there's a great demand from the market to find these products. I would say that most important thing when something new and something is growing, people need to be very careful because there's risk involved. And the best way to decrease your risk is through knowledge.
Sure. So finally, where can investors go to learn more or access these strategies?
Sure. Like our website has a lot of information, and feel free to give our office a call, and happy to talk to any investor at all.
Paul's personal hotline.
Absolutely.
Thanks for joining Livewire today, Paul.
No problem. Thank you.
If you enjoyed that interview, give it a like and don't forget to subscribe to our YouTube channel. We release new content every week.